5 a.m. in New York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. President Trump adds new demands on Iran, dimming prospects for an immediate deal on the Strait of Hormuz. Crude rising for a fifth day, putting inflation back in focus before key U.S. consumer price data. And the AI boom pulling in more money. Nvidia taps Wall Street for $500 billion as Intel brings in $20 billion. Let's get a check on markets around the world now. Mixed session in Asia. Let's get to Paul Dobson in Singapore for the latest. Paul.
Good morning, Bonnie. Rising oil prices really the salient narrative for Asia's markets today. Not good news for a lot of Asia's markets as well. Not good news for government bonds because rising oil prices, of course, are inflationary. Not good news for Asia's currency markets overall either because, it pushes up potentially the US dollar and therefore weakens Asian currencies. And two, for crude oil importing nations like the Philippine peso there, it's an extra negative because it's going to drive up their costs. The dog that didn't bark today was the Japanese yen. Yesterday, it continued to weaken against the dollar. It gave up half of all of the gains that it saw from that intervention in currency markets we saw from the Japanese authorities and the US as well. Today, a little bit frozen in the headlights. People worried about the US CPI data tomorrow. It is a holiday in Japan today, so liquidity is relatively thin. If we flip over the board, something from the equities market I wanted to point out to you that I also found quite interesting in today's session was just the continuing gains for Singapore's STI. Bit of an unloved index relative to broader markets, but as you can see, its performance year to date is now ahead of the broader MSCI Asia index. It had another update today. Two things going in its favor. One, GDP data, which not only had a beat for the second quarter, but the forecast was revised higher considerably for the rest of the year. Two, we had bank earnings last week, which was also very strong as well, and that's giving it extra impetus too.
Paul, wonderful stuff. I love that. The yen maybe yelping but not barking quite yet. That is Paul Dobson in Singapore. Now let's get to London for a look at the European session with Justina Lee. Justina.
Good morning, Bonnie. Now, today's a reminder that European assets remain very sensitive to moves in oil. So, of course, the Stocks Europe 600 is down a little bit today, dragged down by a lot of those treasure and leisure names. Now, of course, when oil prices rise, bond yields usually follow. But what I find interesting here is that we've seen a lot more sensitivity in UK bonds lately. You know, today, the 10-year yield in the UK is up 5 basis points, when the German yield is only up around 2. But on to better news, if we flip the board here, this is the spread between the U.S. and the German 30 bond yield. Now, this is the long end of the yield curve, so it reflects a lot of the inflationary outlook, the fiscal risks. And you can see the spread has been widening, and I think that reflects a lot of the concerns over the Federal Reserve's commitment to containing inflation, whereas maybe investors don't have similar questions in Europe. And at the same time, we're also seeing the euro near a 2-month high, and I think that reflects some of the actually more optimism around Europe lately.
Justina, thank you. That's Justina Lee in London. Oil, the dominant or one of the dominant themes here in the United States as well. Perhaps equity index futures holding up a little better than bond yields, but we definitely are seeing Brent very close to $90 a barrel now, and the SPR at a 40-year low, so it's perhaps more urgent this time around that we're seeing oil prices rise. WTI very close to $85 a barrel. Nasdaq 100 futures just flipped negative, but they were green until a moment ago. As you can see, we're wavering here. Yet we have lower on S&P futures and Russell 2000 futures as well, but very, very fractionally. So a little bit like yesterday, and now yesterday we did end fractionally lower on the S&P 500. And in terms of the Nasdaq 100, we were down 0.3%. The SOX, really the cause of that, down 3% almost at the close. So we'll see what the session brings today after more announcements of this financing from AI companies. But let's switch to the yields board because that's where the focus will be as oil prices rise. Look at that 10-year yield, very close now to 4.73, and we're within half a basis point of the July high on the 30-year yield. We're very close to 5.28. Again, the 2-year yield up several basis points and another basis point higher this morning at 4.25.55. Volume, by the way, for equities at least, at a 2-week low at the moment. All right, let's get to some individual market movers now. For that, we'll go back over to London and Chloe Melly.
Good morning, Vonnie. Intel has raised $20 billion in an upsized share sale, which was more than it was targeting, and that showed a little bit the resilience of that demand for AI-related stocks. But we are seeing a little bit of weakness this morning for Intel. We're down about 1% in pre-market trading. Moving on to Riot Platforms, which is a Bitcoin mining company that has recently started selling AI data center capacity, and it's up very strongly this morning on a report that it has struck a $9 billion deal with Anthropic, which has been really trying to boost that computing capacity. So we're up almost 19% this morning. And finally, another final tech stock, we've got Fermi, which is a data center campus operator, and it signed a lease with TensorWave for a big, massive project in West Texas, which is currently under development. And so that's big relief for the company after some recent trouble. And we're up also about 90% in pre-market trading this morning.
All right, some massive gains and losses there. Chloe, thank you so much. Chloe Melly will be back later in the hour. Also coming up this hour, we'll discuss more on the inflation woes facing the Fed and how this bond market is coping with Laura Cooper of Nuveen. Oil extending its rally then as President Trump makes sweeping new demands of Iran. Washington seeking compensation now for damage and deaths across the Middle East and in the United States. This coming in response to Tehran's requests for reparations over the war. Let's get straight to Bloomberg's Abir Abu Omar for the latest. More demands from the US in response potentially to demands from Iran, Abir, but Iran already wasn't at the table. So how does this change things?
Good morning, Vonnie. Yeah, well, President Trump seems to be matching what Iran had asked for. Now, over the weekend, we reported that some hardliners that were reshuffled in the Iranian government had started making demands for the end of the war in the Middle East, namely the end of the U.S. naval blockade, the permanent end to the war in the region, unblocking those frozen assets, lifting those oil sanctions, amongst some many other demands. Now, that is not the formal line that we had reported out of Iran, but in return, President Trump, in his latest remarks, saying that he will likewise be demanding compensation from Iran for all of the people that they have killed and gravely wounded with their roadside bombs in many conflicts. He also had accused Iran of the damages and the tragedies in countries nearby in the region, including Lebanon, Syria, Yemen, and Gaza. Now, he didn't give a lot of clarification on what exactly that means, but he did say that that compensation will be part of all the future negotiations taking place in Iran or with Iran. Meanwhile, of course, we've reported that for the time being, Washington does not seem to be involved in those wider negotiations about the Strait of Hormuz that are taking place with Oman about a mechanism to open up the waterway in some fashion. We still don't have that formalized document, Vonnie, that we understand will be provided soon. We understand is in the final stages for us to figure out how Iran and Oman will be able to reopen the Strait of Hormuz for a temporary basis, of course, and have that trickle of movement through the strait, the crucial waterway, of course. But that lack of clarity, as you can see, is driving up oil prices, both NY crude and Brent, that is edging very, very close at this point to $90 on the barrel yet again.
Yeah, hard to know what the holdup is. Abir, thank you so much. Abir Abu Omar in Dubai. Treasuries under pressure as that rise in oil prices revives inflation concerns ahead of Wednesday's CPI report. Bloomberg's Ven Ram joins us now. Ven, we're very close to our recent highs, 528 practically on the 30-year, and we're up to 572 now on the 10-year. How concerning is this?
It is deeply concerning for the bond markets, and bond market vigilantes are in action clearly, and they want answers. They want answers on a couple of crucial questions. What is the fiscal direction of the US and the other economies? The second question they desperately want an answer to is, what is the solution to the inflation overshoot that we have been seeing? If you look at the US and the UK and many other economies, indeed, we haven't seen 2% inflation for a long time now, for 5 years now. So what is do the central banks really have a solution to this? If not, then we will penalize them by sending bond rates and yields higher, and that's precisely what they've been doing.
It seems like the market has gone on two different tracks now. So equities are just looking at earnings, and they're quite happy with earnings, and we're hitting records. Bonds have suddenly, and it is pretty suddenly, decided to be concerned about the fiscal situation. Where was that concern the last several years, then?
Well, we have been getting here in fits and starts, and what you're talking about is absolutely true, because the market has this tendency to sell off in fits and starts. It's episodic in nature. Financial market stress is always episodic in nature, and that's what we have been seeing. It doesn't happen in one clean swoop where yields go from 4.5 to say 5.5%. It happens in stages and in steps, and that's the way the trading world works, because the market goes up, the yield goes up a bit, and then shorts take profits, and then we come off a little, and then we go back again. And that's the way the game works. But the trend is what is important, and what the trend shows is that the markets are not in any mood to condone fiscal profligacy, nor are they willing to underwrite an inflation overshoot for too long.
Then, as we get incrementally higher on yields, are we getting into an incrementally more precarious situation where we might see some kind of a tantrum or a shock in the bond market?
Well, it is already a shock. I mean, if you look at the 30-year US yield, we are in some kind of a shock because we haven't seen those rates for a very long time. And I think that, if yields keep pushing higher on the 30-year, then Treasury Secretary Scott Bessent will have a problem in his hands, because he needs to send a clear message that they are doing something, and the Fed, for its part, needs to address the inflation mandate of its mandate.
Japan on holiday today then, but we're at 159.36 once again on the yen. I'm curious, will there be appetite for the Treasury to get involved a second time, given, the precarity of the domestic situation?
Well, I think that there are limits to how far the Treasury can rescue the yen, because the FX reserves, the US FX reserves, are pretty minuscule in comparison to what a lot of the other economies have. So it's not an endless barrel, and they can't frankly afford to do it anymore. They've already done what they could. They've showed their hand. They've moved on, and I think that it's for Japan to fix their problems. And the way to fix that problem is for the Bank of Japan to come out and say that, look, we are going to be putting up rates at a pretty quick pace and get to neutral. That will be the first stop. If they did that quickly enough, the markets will correct themselves and the yen will go higher. All
right, Ven, we'll await that. Japan on holiday, of course, today. Bloomberg's Ven Ram. Thank you. Now, to other top stories trending on the terminal this morning. A magnitude 7.4 earthquake struck Colombia Monday morning, causing significant damage and leaving at least 132 dead in the Pacific region and the Central Andes. The earthquake has affected Colombia's coffee region, with major roads closed due to landslides and operations suspended at 5 airports in the affected region. President Trump has renewed efforts to overhaul the U.S. childhood vaccination schedule, recommending that the combined measles, mumps and rubella vaccine be split into separate shots. Trump has connected the issue of vaccinations to rising rates of autism among children in the U.S. Scientific evidence has shown no link between the condition and immunizations. And a Florida energy tycoon who long served as a back channel between Washington and Caracas has agreed to sell his interests in Venezuela's second largest oil producer. It follows a pressure campaign from the Trump administration that wanted Harry Sargent to divest from the company. Coming up, Intel brings in triple its target in an upsized share sale. More next. This is Bloomberg. This is Bloomberg Brief. I'm Vonnie Quinn in New York. A wave of AI financing deals announced. Apollo, Blackstone, BlackRock, Goldman, KKR and Brookfield all announcing a partnership with Nvidia to source $500 billion in financing for AI infrastructure. Joining us now is Bloomberg's Neil Campling. Neil, it's third-party capital, so it's third-party risk. Who's going to be taking on this risk? Is it essentially more public debt coming to the markets?
Yeah, morning, Bonnie. It's an interesting question. It doesn't put to bed any of the whole circular financing in AI questions that have been raised recently, and it's unclear whether there is an Nvidia backstop to 25% of this $500 million or not. So it kind of raises more questions it provides answers to. There's clearly a lot of appetite for AI debt, for AI assets of any kind. But this is just yet more questions going to be raised around when the music stops, or will it stop, in terms of the whole financing questions in AI.
Nvidia in particular is seeing a little more pressure in its CDSs, at least 20 basis points above CDSs of Amazon, Microsoft, all of the hyperscalers. I mean, at what point does that seem unpalatable to investors. How much more will they want in order to keep digesting Nvidia?
Yeah, this is it's an interesting point because obviously, Nvidia has got a good balance sheet. It does generate good free cash flow. It has a low valuation multiple. And yet, as you mentioned, the CDS spreads have blown out above the hyperscalers themselves, which is perhaps somewhat surprising. And that move has happened over the last couple of weeks. So clearly there's going to be questions around the whole financing when we get to their earnings later this month. But it's something to be aware of. And this is quite an unusual move to see Nvidia's CDS go above some of the other hyperscalers, I think.
Now, Intel raised $20 billion. The stock was obviously lower yesterday, a little bit lower in the pre-market, but there's obviously no end to the appetite for chip makers' stock, right? It got actually a third more than it was looking for.
It did, and apparently, according to the Bloomberg terminal stories, over $100 billion worth of demand for this particular offering. Stock has performed very well this year. They're taking advantage of that. They need to expand their own capacity. They're using this as a tool to do that as well. And I think this is the first time of bringing the sort of public equity sale to the market since going public more than 50 years ago.
Anthropic story today, because there's always one every day. It struck a $9 billion cloud deal with Riot Platforms. Riot, obviously, data center capacity is the new Bitcoin reserve, right? But Riot has decided to lease some compute to Anthropic for a long time. It's going to be $9 billion worth. Just how much data center capacity does Anthropic need?
It appears to be as much as it can possibly get. Obviously, the compute power requirements are enormous. And Riot is one of those kind of, I suppose, in a rare situation where it actually has compute power available today. So that's probably partly the reason for this particular deal. But Anthropic's demands, as you say, nearly every day we're getting stories around Riot, sort of about the requirements Anthropic's had, and there's no sign of that stopping anytime soon.
Yeah, apparently infinite. OpenAI buying back about $7 billion of employee shares in a tender offer ahead of the IPO. Periodically, private companies do this, right? But why now? Is there some signal we should read into this? Because we're pretty close to what we're expecting to be the IPO.
Yeah, indeed it is. I think what's interesting about this particular deal is two things, actually. Firstly, that it's kind of a self offering to their employees rather than going to third parties to provide some backstop to this kind of this requirement. And the second thing is the valuation being talked about here is the same valuation as the last raising 5 months ago. So there's no increase to the valuation, which perhaps is a surprise given all the growth that we're talking about in the AI sphere.
Neil, thank you. Covering the gamut of tech stories for us this morning and AI stories. That's Neil Campling there in London. Turning to autos now, General Motors moving further away from electric cars, selling half of its planned $3.5 billion EV battery joint venture in Indiana to its partner Samsung SDI. Bloomberg's Danny Lee joins us now. It's a further retreat for GM. Danny, is it the right strategy? Is GM sure that EVs won't take off again?
Yeah, good morning, Vonnie. And this kind of retreat it does first of all confirm a Bloomberg scoop earlier in the day. But on top of that, the fact that this is GM right-sizing their kind of production, the capacity and demand, the overall reality is that at this point this year, they would have expected to sold actually 1 million units a year of EVs. By the end of last year, they sold something like 170,000 units. So there's a big mismatch, and all the commitments it has made with partners such as Samsung SDI, previously LG Energy, which it sold it's part of a battery factory back in 2024. This is just GM right-sizing what it believes is the normal course of action for the kind of demand it sees, in particular a key market like the US, which has gone through such a change in the kind of mood music for EVs overall, and particularly as President Trump came in early to his presidency to try and upend that kind of federal support for EVs overall. So this is just GM, matching what it believes is the right thing. But of course, it just sums up just how much it's been costly for GM. The fact that it's had $11 billion of write-downs, and also the investment it has made, $35 billion overall in EVs, and it's really not paid off so far.
No, indeed. Yeah, and a bit of a capitulation to China as well. Danny, thank you so much. Bloomberg's Danny Lee. Coming up, Anthropic shoring up investor confidence ahead of a potential IPO. More on that and a look at what else is making headlines in your front page news. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for your front page news. First up, the Wall Street Journal reporting Anthropic is trying to shore up investor confidence before its IPO. The Journal is saying Anthropic is targeting a public debut in September or early October and has told investors it plans to push further into healthcare and biology AI uses to mitigate negative sentiment around AI. Next up on the Financial Times, Hong Kong regulators may include trading firms, Jane Street, Citadel Securities and others in a sweeping new tax regime that has already boosted the city's appeal to hedge funds. The FT says governments plan to offer exemptions on taxes paid on performance fees, and that could be expanded to trading firms. It was already being planned for PE firms and hedge funds. And finally, the Washington Post leading with Iranian assassination threat against President Trump, prompting an operation in which he flew secretly from Turkey on an alternate military aircraft while the White House said he was aboard Air Force One. The president boarded an old Air Force One in view of cameras, but then was secretly shuttled to a smaller plane. Coming up, we're going to speak about the bond market with Laura Cooper of Nuveen. It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. President Trump adds new demands on Iran, dimming prospects for an immediate deal on the Strait of Hormuz. Crude rising for a fifth day, putting inflation back in focus before key U.S. consumer price data. And the AI boom pulling in more money. Nvidia taps Wall Street for $500 billion as Intel brings in $20 billion. Let's start with oil because those fresh demands already pushing oil higher. And then just a few minutes ago, we got a report that the UK MTO said it received a report of an incident involving a tanker and military forces in the Gulf of Oman, sending oil even higher. Brent crude very close to $90 a barrel now. WTI almost at 85. And bear in mind, the SPR is at a 40-year low here in the United States, so it is getting to be a little bit more urgent as oil prices rise. European gas futures at 61 and change per megawatt hour. That is hurting Europe, no doubt. Let's take a look at yields because they're pushing higher too off the back of these oil prices, but also just as concerns run rampant. We're very close to our recent highs on the 30-year yield, within half a basis point at 527.25, and that 10-year yield is all the way up to almost 473. Needless to say, the 2-year yield is at 425.35 before that CPI data tomorrow. Equities holding up a little better, even with these oil price gains. As you can see, we're very, very mixed, though we're actually at our session highs with S&P futures and Nasdaq 100 futures just crawling into the green after a fractionally down day for the S&P yesterday. The Nasdaq was down 0.3%, mostly thanks to the SOX. It was down nearly 3%, that index. We are seeing a bit of a rotation back into software and services, obviously. That index up 33% from its June closing low. And of course, volume a little bit lighter. We're at about a 2-week low in terms of equity index trading volume. Let's get to some individual market movers now. Back to London and Chloe Melly.
Good morning, Bonnie. We've got the sneaker maker on sinking this morning after lower than expected sales in the second quarter, as well as a watered down outlook for the sales for the year. And it seems that it was really due to the company not discounting older models, which really weighed on performance. And we can see that reflected in that share price this morning. We're down almost 15% in pre-market trading. Moving on to the telehealth company Hims & Hers, which has cut its outlook as well. This company has also said that it was planning on entering the peptides market, but it seems that this upcoming entry into a really booming part of the healthcare industry was not enough to reassure investors given this guidance cut. And so we're down about 6.5% there. And finally, let's move on to a positive mover. We've got Riot Platforms, which is a Bitcoin mining company that has recently started selling AI data center capacity. We are seeing that company rallying this morning in pre-market trading on a report that has struck a $9 billion deal with Anthropic as Anthropic really tries to expand this computing capacity. And so we're up very strongly there for Riot Platforms.
Yes, indeed we are. That is great. Chloe, thank you so much. Chloe Melly there in London. Well, with yields a hair's breadth away from recent highs, let's bring in Laura Cooper, Global Investment Strategist and Head of Macro Credit at Nuveen. Of course, we have a lot to come. Jackson Hole at the end of August, Laura, and tomorrow's CPI, among a raft of inflation data we're going to get this week. What is sending yields to this level right now?
I think what's been most interesting about the backup that we have seen in yields is the composition of that sell-off. In terms of, we're seeing it predominantly being driven by real yields and less so in terms of inflation expectations, which is perhaps counter to what one would expect when we are navigating potentially higher than inflation regime with an energy shock. And I think that really does feed into a key debate that the Fed is currently having, in that are rates where they currently are in terms of interest rates, are they sufficient enough, sufficiently restrictive enough to not warrant a rate hike from the Fed, but they can stay on pause? Or are we going to see signs of price persistence come through? And that does warrant the Fed maybe having to start to tighten policy in September.
Well, it's a quieter calendar of Fed speak this week than it was last year at the same time. But we did have Beth Hammock speaking yesterday saying some number of rate hikes may be necessary. Well, that's at least one, right? So she can't be too worried about any fragilities of the labour market or otherwise.
And I think it's a really interesting dynamic in terms of the dissents that we did see back in the July meeting. And I think the risk is that if the Fed does tighten policy rates in September, then to Hammock's point, markets will start extrapolating that and pricing in the resumption of a tightening cycle. And it's not clear that the data would warrant that. Yes, we could potentially see some hotter than expected inflation move the needle in terms of that Fed rate pricing. But if we look at the broader inflationary trend, we are seeing unit labor costs ease. That tends to be correlated with inflation. And we're seeing that softness in the labor market, and as well housing inflation as well is also expected to start to slow. So it's not clear that the Fed really needs to take an aggressive stance, as Hammock is potentially alluding to.
If we do see real yields continue to stay around these levels or even potentially go higher, though, Laura, how much is there the possibility that we'll see real difficulties in corners of the market? I'm thinking the amount of AI debt that's out there and that's coming to market, for example.
And that's certainly a key risk. And the fact of, how much can financial conditions tighten before it starts to weigh on the overall growth outlook? Now, that's not been the case so far, despite the backup that we are seeing in yields, because we are still seeing signs of a very resilient backdrop. Looking at where GDP is tracking in Q3, still to be quite resilient. But I think if we start to really test that 5% handle in the 10-year yield, and that's real yield driven, perhaps then that could be quite concerning. And again, it's one of the reasons why we think the Fed is going to take more of a wait and see stance to see how the data unfolds, because as Warsh has alluded to, this is a Fed that is very data dependent, and they're not going to give the type of guidance. But certainly markets will be watching for all of these indicators coming through for how much they can price in that tightening.
How will the data have to unfold before the Fed actually pulls the trigger on a hike, though, Laura? Because, obviously oil is going higher right now. That's going to start playing into the inflation data that we're getting in the next month or so. Will that be enough if we see oil-related inflation?
Well, one could argue that oil price effects are relatively transitory. It's more around the oil price volatility. That does tend to lend itself to higher core inflation over time. But I think something that came out of Chair Warsh's press conference in July was really interesting. And the fact he said that they are looking at a broad range of underlying inflation metrics rather than just kind of hinging their view on one key inflation point or their preferred Fed gauge around core PCE inflation. So that suggests to us that they're not going to look at one or two data points, but really a basket of data points coming through more meaningfully. Certainly, if we see an upside surprise this week in CPI against another upside surprise in August inflation, perhaps that could tilt the scales a little bit more so. But I think really Jackson Hole maybe is kind of that key pivot point for whether we start to see any further guidance in terms of what that September meeting could be.
Laura, take us through the process for you and your team when a whole new batch of hyperscaler or other AI company debt deals come down the line. I mean, we're seeing another $500 billion of Nvidia, in consort with a consortium of companies, right? That's going to come to market at some point. So what does your team do?
It's a fascinating time to be kind of a credit analyst at this juncture. I mean, we've already seen hyperscaler debt as a share of the U.S. investment grade market double to about 4%. If we look at what estimates are for capex in coming years of about $2 trillion from these hyperscalers, well, these hyperscalers could account for anywhere upwards of 1/4 of the U.S. debt market in terms of investment grade. So that's quite notable. I think the way that we look at it is certainly we are seeing this being a dominant technical in the market. And interestingly, despite hyperscalers coming to market with more than $220 billion of issuance this year, that's not actually crowding out the market. We're seeing tight spreads across the space. So we suspect this is going to lend itself to more dispersion at the security level. And so that does warrant a much more selective approach, looking at high quality hyperscalers and even looking at old economy sectors like industrials, materials, and energy infrastructure that are going to be AI adjacent, let's say, and not directly exposed to AI disruption risks and some of that pure play AI software that is more vulnerable.
Fascinating. We'll continue to keep an eye on this story, Laura. Thank you so much. That is Laura Cooper of Nuveen joining us this morning. Now, two other top stories trending on the terminal. President Trump defends embattled FIFA President Gianni Infantino amid a growing revolt that threatens Infantino's leadership. The president posting on Truth Social, quote, FIFA would be making a terrible mistake if they even considered replacing President Gianni Infantino, unquote. Infantino is facing criticism over his failed plan to spin off FIFA's commercial operations. Google's AI team is encouraging job candidates for its open roles to fill out a special form alongside their application to eliminate the risk it may be automatically screened out by the company's internal AI systems. This according to a document viewed by Bloomberg. Google denied that the company's systems filter out applicants incorrectly. And a state court judge has issued a restraining order against New York City, temporarily blocking the rollout of Mayor Mamdani's new pied-à-terre tax. The suing homeowners said the city had caused mass confusion with its controversial identification of thousands of properties that it says are potentially subject to the tax on second homes. Coming up, President Trump's new demands on Iran put hopes for a deal in doubt. More next. This is Bloomberg.
Back to the subject of Iran, sir. Can you give us any estimate of when you think the Strait of Hormuz will be part of the deal?
Well, it's open now. We're taking a lot of ships. It's open now. Look, the only one that has control of the Strait of Hormuz right now is the United States Navy. We have a blockade that's been infallible. It's a steel wall. And we let people in that we want to let in, and those people come in, and they've been coming in and they're going out. So it's actually open now.
Bloomberg senior White House reporter Josh Wingrove questioning President Trump there in the Oval Office. The president's sweeping new demands on Iran have clouded the outlook for a deal to reopen the Strait of Hormuz. Joining us now is Rachel Schilke of Bloomberg Government. So it seems the president is mirroring previous demands by Iran for the U.S. to pay, right? Iran wasn't at the table, Rachel. So what is the administration thinking? Is this going to bring Iran to the table?
Well, the president has tried to shy away from any sort of physical attacks. He stepped away from reoccurring bombing of the country. And so the administration right now is hoping to put this economic pressure on Iran to try and bring them to the table, and is demanding that they pay reparations for all of the damage done, not only to the Strait, but also to their own people. So it's something that I think that the administration is hoping that the more and more that they put this pressure on, that they will see some sort of deal that comes in their favor. But their time is kind of running out because we are getting close to the midterms where President Trump is hitting term lows. Republicans kind of have a dark cloud somewhat hanging over them with this. And it's already hard for them to get GOP voters out. And with oil prices rising and just energy not where it's supposed to be, Republicans are going to have a hard time if this economic pressure doesn't pan out.
Yeah, I mean, Election Day is literally 12 weeks away. Early voting starting September 18th, which is just more than a month away at this point. So it's getting really crucial. Domestically, President Trump has cited an unproven autism risk because he's trying to separate the MMR vaccine. Now, what happens next? Does that automatically become what happens when you go into a doctor's office now, that they're separated, or does something more need to happen before this becomes reality?
Well, as we've seen with a lot of President Trump's executive orders, there is some pushback. So I think you can expect a lot of different healthcare associations to weigh in, and you're going to see a lot of offices and doctors' organizations trying to make sure that they're putting out their research that these vaccines are necessary. We've heard this from the administration before. They've taken some somewhat peculiar stances on vaccines than maybe we've seen in previous administrations. And again, it's another thing that is just adding, as you mentioned, to these early voting days, these midterms, where all these different things that are piling up that Republicans will have to answer for that are not popular at the ballot box. And so the more that President Trump kind of starts putting these executive orders out for various things, whether it's foreign policy or healthcare, it's just more and more things that congressional Republicans will have to answer for.
More congressional primary elections today. So we have Connecticut, Minnesota, Vermont and Wisconsin. I guess the Minnesota governor's race is one to watch, but President Trump has in fact endorsed quite the amount of candidates today.
Yeah, we've seen him endorse quite a bit. We've even seen him endorse against some congressional Republicans. He just recently had in the last slow primaries a mostly positive win. He did lose Rep. Andy Ogles from Tennessee, and so that was kind of a hit. But the president has continued to say that his candidates are doing well, that Republicans are going to keep Congress. So these next slate of midterms will be very interesting to watch. Especially we have a South Carolina Senate GOP primary after the death of Lindsey Graham. So there's going to be a lot of different races that we're paying attention to today, and I think a lot of people will be paying attention to see kind of the scope of where Republicans are at heading into some of these difficult general elections that they're going to have to win in order to keep their majorities.
Yeah, we'll have all of the results tomorrow morning. Rachel, thank you so much. Rachel Schilke of Bloomberg Government in Washington. Turning to tech, Wall Street giants looking past AI fears and a whopping $500 billion commitment to fund infrastructure for Nvidia. CEO Jensen Huang saying, quote, "These financing platforms will help customers access scarce compute at scale and build the AI factories that will power every industry and country in the age of AI." Joining us now is Matt Bloxham of Bloomberg Intelligence. So Jensen Huang is solving the financing problem for all of his peers as well as himself, Matt. The only trouble is the risk is going to get outsourced. Is there enough appetite?
There seems to be enough appetite for AI-related capital right now. You know, we've also got this kind of Intel raise going on, and Google's raising money too. So I think, you know, generally that the AI economy is hungry for capital, and the capital seems to be there. You know, this is kind of a very broad deal, but ultimately, you know, Nvidia is hoping that it's going to be a catalyst for people to kind of spend more money on their kit, and it just kind of adds to this complex circular economy that we have building around AI, and potentially, I think, raise some questions about the possibility of systemic risk somewhere down the line. You know, given that we're kind of really drawing some huge financing institutions into the funding for AI.
Yeah, that's a great point. I mean, Apollo, Blackstone, BlackRock, KKR, Brookfield, Goldman Sachs, everybody and anybody. I mean, Goldman is the only bank in there, I guess, but everybody else is involved. What will it look like? So it's going to be a $500 billion platform, but will it look like chunks of, you know, structured products coming to the market?
Yeah, I mean, obviously details are quite thin right now, but I think given the size of it, it's going to be a huge spread of things, from classic vendor financing through to perhaps stuff that looks a lot more like kind of long-term infrastructure funding. And, you know, Jensen Huang was very clear to kind of describe these companies as the providers of long-term capital. You know, the vendor financing market in itself is probably worth less than $100 billion, so it massively swamps that. But yeah, ultimately, I think we're going to see lots of different deals, some of it going towards funding the underlying infrastructure, so data centers, even the power that's necessary to kind of deliver into those data centers. Some of it's going to be, I think, more traditional vendor financing, where a customer says, okay, I need a certain number of Nvidia chips to kind of fund my plans, and this helps to kind of facilitate access to that capability.
Yeah. Now, Anthropic has struck a $9 billion cloud deal with Riot Platforms, of all companies. It's fascinating. Anthropic seems to have just a massive appetite for compute. Can it continue with these deals?
Yeah, it doesn't. I don't think Anthropic's alone. That all of these big cloud platforms AI platforms are looking for near-term compute capacity to meet the demand they're seeing from their customers. You'll see there's a lot going on for the kind of mid to long term building out additional infrastructure, but they need stuff now. And companies like Riot Platforms, which is a Bitcoin platform that has invested over the last few years in a lot of compute capacity, realizing that actually there's probably a better return for them on the investment they've made by selling it on to these big AI platforms than there is by kind of growing their business organically. We've seen similar deals on the margin with SpaceX. Meta's looking to kind of make some of its capacity available to others. So, I think this is just kind of a kind of necessary fluid part of the market that as companies like Anthropic look to honor near-term customer demand, they find the compute capacity wherever they can get it.
Matt, is this something that all Bitcoin and Bitcoin reserve companies have sort of, as a deck of cards, let's say, in their back pocket? Would it be the next wave for all these Bitcoin reserve companies to sort of pivot and lease out their compute? Is it because of Bitcoin that they have all this compute?
Yeah, I think it's certainly a possibility that other companies are going to be looking at the compute capacity they have and thinking about the best way to get a return on it. Actually, even almost a year ago, I was at a big infrastructure investor event, and even one row down, there were companies that had been buying land banks, so banks of land that could at some point be kind of used for commercial or residential kind of real estate or possibly data centers, and they're actually finding they could sell that land bank on at a big premium because already back then there was huge demand for all of the bits of the jigsaw that goes into making these big data centers. So I think lots of people in this kind of complex value chain are rethinking the investments they've made and the best way to make a return on them.
Yeah, incredible. Matt, thank you so much. That's Matt Bloxham of Bloomberg Intelligence. Coming up, more tech earnings on deck. We'll get you set up for your trading day. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. First up, we get ADP employment data for another read on the labour market. That comes at 8:15 a.m. Eastern Time. Then existing home sales out at 10. And we get earnings from Supermicro and CoreWeave, some interesting ones after the close. Let's take a look at some stocks moving pretty substantially pre-market. So Riot Platforms up 21%. Have a mixed set of earnings, but it did strike a $9 billion multi-year cloud deal with Anthropic. So it's leasing compute essentially, and that's sending those shares more than a fifth higher. Rocket Lab. A little bit of a disappointment here. Weaker than expected outlook, caution around fresh risks to key neutron rocket debuts and so on. That's down 9%. There had been a lot of expectation that some of these space companies would outperform. Well, not Rocket Lab. It had been higher in the previous two sessions. And Hims and Hers as well, a very mixed outlook for Hims and Hers in terms of earnings, down almost 6.5%. It lowered its full year outlook. One good piece of news potentially for this company: it does plan to allow some allowed peptides by the year end. Let's take a look at your macro picture. Yields really rising as Brent crude approaches $90 a barrel. You have your 10-year yield close to 4.73 right now. Nasdaq 100 futures, though, pointed higher.